Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 20th of May. Indices were slightly higher last week, the main indices, the S&P, the Nasdaq and the Dow Jones, but it was the small caps, the Russell 2000 that really shone, with a really nice breakout. And I spoke about this last week and pointed to the fact that the Russell was on the cusp of doing that. And the small caps had a really solid week. So what the indices are doing is not necessarily the thing that you need to follow. You need to look under the hood a fair bit because there's some just terrific outperformance happening at that level. All right, let's jump in and have a look in this update. I'm just going to have a look, examine that a little bit further. And roughly 10% of the industry groups, so depending on which database you use, there's somewhere between 210 and 234 industry groups in America that reflect every stock on the market. And roughly 10% of those industry groups are significantly outperforming the main indices, and that's the lake that I fish in. We'll also be looking at the normal stock and commodity trend update. And last week, I did look at US consumer discretionary stocks in Portfolio Analyst. I identified, looked at about 6 or 7. I made, I think, 5 or 6 buy recommendations. And pleasingly, they all had a good week and followed through very nicely. So last week, the S&P was actually down slightly, 0.5% on the week. It was quite a sustained move out of the triangle that we've seen over the last couple of weeks, and we'll take a look at that chart in a minute. But I think the big news story is that the small caps are outperforming, and that's always a really good sign for a healthy market. The US dollar still trending higher. Basically, it managed to grind its way higher every session. And there's still a few more percentage points yet on the dollar index before it runs into some resistance. So we could see that continuing to move higher. And of course, a good part of the reason for that is that the 10-year bond yield is sustaining itself now above 3%. Now, a lot of people, kind of freaked out at that and thought the interest rates rising is bad for stocks. But that generally takes a couple of years from the start of the interest rate cycle, and you've got to get closer to 5% on the 10-year bond before it actually becomes an issue and of relative valuations, and people start looking far more favourably at bonds. So we're a long way short of that point, and that's why the market's continuing to move higher. So let's jump in and take a look. And we'll start, first of all, with the S&P. That's the S&P on a monthly basis. So you can see we had a little dip since the start of the year, but it's starting to turn and head back up again. On a daily basis, you can see slightly lower on the S&P. I think the Nasdaq was pretty flat, but you can see that it's broken out of this triangular formation here. But not with a great deal of momentum. So it's still sort of really struggling to gather some momentum. If we look at the Russell Index via the QQQ, you can see it was also down very slightly on the week, but is still basically trending upwards on a bigger picture view. But the action was in the Russell 2000, so this is all-time highs. We had a really nice inclined triangle formation that I showed you last week, and I said that it was right on the cusp of, so that was where it finished the Friday before last. We had a couple of days down Monday and Tuesday, and then really firmed up towards the end of the week and broke out. So that's a very significant move for the small caps, and it really reflects the fact that domestic businesses are doing well. They're not involved in these trade tariff negotiations, and yes, generally the US economy's in good shape. Earnings season has been terrific. One of the best earnings seasons we've seen in the last decade, and it's just fueling the rise in these small caps. Let's look at the US dollar index. So there you can see we moved higher on each session last week. We'll probably run into some resistance, I would think, up here just above 95 on the index. We're currently about 93.5, so still a bit of a way to go yet on that. And just taking a bit of a bigger picture look, it certainly would appear now that the US dollar has found stability, and it'll be interesting to see what it does around this resistance level. Okay, so the Aussie stocks, the Aussie dollar was down slightly to 75.1, which just reflects the US dollar going higher. And despite the fact that commodities are still doing fairly well, our dollar is not really responding to that, and it's being outweighed by the rise in the US dollar, as indeed it should. And I think the Aussie dollar is still overvalued. Now, our index declined by 0.5% on the week. And it was a pretty simple story. Resources were up, energy and mining, and banks were down a little bit. And I think I'm going to be saying that a lot throughout the rest of this year, because the directions look pretty set. It's hard to see the banks gaining any traction. I wouldn't be piling into BHP and Rio at the moment. I think they're very much overbought. It's a very crowded trade as well. But the medium-term direction is up, so perhaps buying some sort of dip in those major miners is the way to go. Turning now to precious metals, gold declined by $27 to be under $1,300 at the finish of the week. Now, roughly 1/3 of that was currency impact, so the US dollar going up. But the other 2/3 was really active selling on the fact that interest rates are rising, and rising interest rates, generally aren't good for gold, because gold doesn't have a yield, doesn't produce an income, and so a lot of people look at that and think, well, I'll sell gold and I'll buy bonds because it's at least paying me 3%. So rising interest rate environment is never particularly good for gold. The stocks are still not happening for the global majors. There's really nothing much going on there at all. But our local producers remain in strong uptrend on a medium to longer term basis, and they've been in that trend now for some time. Last week there was a bit of a pause, a small dip in most of them, but the trend is clearly higher, and that's being helped by the Australian dollar starting to come off a bit now. So let's take a look first of all at, we'll look at the materials index in Australia. So you can see we've broken out in the materials index. We're not at all-time highs that we achieved back in 2011, or in fact even 2008 it was higher. So you can see we're still well below the 2011 peak, but it's been a pretty strong run since the start of 2016. So about 2.25 years now, the index has doubled as a rough guide. Now, if we look at energy was clearly a big winner again last week, and there's a very, very strong uptrend. It's still well off its highs, but it's at least trending in the right direction. Finance, however, still struggling, and as you can see, we've turned down the last couple of weeks. And finally, this is the ASX 200. So we've broken above 6,000, so that's the first bit of positive news, and we're just pausing around this double top at the moment. So this is very much a technical pullback, so we'll see how that goes. Moving on now to other commodities. Copper was down slightly to 310, and crude oil also eased slightly, so they're just really currency movements with the US dollar. The energy index is at a pretty vital long-term resistance, as we'll see. So now is not the time to jump on that particular bus. It's had a great run over the last few months, and the nature of how it pauses or pulls back in the next few weeks will tell us a lot about where it's going. But the momentum is huge, and the earnings growth rate in the sector is I think it's about 94% average across the sector. Now that's coming off a low base, but nevertheless, that sort of earnings growth rate wasn't priced into stocks, and that's why they've moved up so sharply. So let's just take a look at XLE. So you can see here we've got quite an important triple top that was formed December 2016, January of this year, and now where we are now. So it would be very normal for the index to pause here. You can see we're overbought. So I would expect some sort of pause or reaction down. If it's shallow on low volume, then you can expect a fairly near-term breakout and a continuation of the uptrend. If it's a bit deeper and it's associated with some active selling by the bigger players, then it'll take a little while longer before we break out. So that's an important one to watch. There's the spot copper chart. Not much happening during the week, and similarly with crude oil, not a lot of change there. So to wrap it up, as I've been saying now for some time, you've just got to stay focused on the strength. The natural human tendency is to want to buy stocks that are cheap when they've been going down for a while, but you've just got to understand the reality of the market, and that is that the institutions don't tend to go into stocks that are underperforming unless they believe they're about to turn higher and embark on a very significant journey northward. The institutions go with what is outperforming now because they are assessed basically every quarter on their performance, and so they can't afford to buy something that is underperforming now but may be an outperformer over the next 6 to 12 months, because that's just not how it works. So stay focused on the strength. Outperformance of particular sectors and industry groups just creates more momentum. It's a self-fulfilling, self-propelling spiral to the upside. Portfolio analyst this week, I'm going to be looking into some more on US industry groups. There's at least 35 industry groups which are really interesting and providing lots of opportunities. And there's no question that this is where the money is. If you want to make short to medium term profit in the stock market, then it's zeroing in on the industry groups that are performing, and then of course finding the strongest stocks within that industry group. Also this week in Portfolio Analyst, I will be looking at doing a review of China stocks that are listed in America, because the inclusion of China A shares into the MSCI Global Tracking Indices starts on the 31st of May. So that's going to be a really interesting section to look at. There's my contact details for those who aren't members, and I look forward to coming back with you next week. Cheers.